Hey everybody, thanks for joining in. I'm Nick Baldwin, co-founder of LabCoat Agents. Got Robert Lucido here from Lucido Global, and we are gonna peek behind the curtain to break down the unseen side of the mortgage process and interest rate forecasts to help provide you with expert level guidance for your buyer clients. So the more you understand about how mortgages work, what rates you can expect, how you can expect them. This is what Robert is gonna do. He's also with Moxie Mortgage, so he's pulling double duty. And so Robert is a loan officer, runs a mortgage company, also a real estate company. So thanks for being here, Rob.
Right on. Let's dive in.
And while
So,
you're at it, hold on, while you're at it, guys, drop in the chat where you guys are watching from. I'd just like to know where people are joining. So anyway, sorry, didn't mean to interrupt. Go ahead.
no, perfect. Yeah, and make sure you're using the chat as we're going through here. So today's presentation will be pretty detailed. At times it'll be in depth. And so if you guys have any questions or clarifications, use the chat box to request them. We'll make sure we circle back. We'll have plenty of time today.
For sure.
All right, so I want to help you guys be better buyer agents by understanding a bit about how the actual mortgage machine works. For 90% of clients, for them to buy a home, they're going to need a mortgage. And so arguably the financing part of it, if you understand it, is a huge game changer for your overall value prop as a buyer agent. So to start, let's look at last year. So last year, interest rates actually ended higher than when the year started. And I'm sure you guys have heard in the news as it was going, as the year was passing, that the Federal Reserve was quote unquote cutting rates. In fact, they cut them by a full point last year. So how is it that the Federal Reserve was cutting rates, quote unquote, yet mortgage rates ended up even higher? And that's because when the Fed funds, excuse me, when the Fed cuts quote unquote interest rates, what they're actually cutting is what's called the federal funds rate. And this is the short-term, ultra short-term interest rate that banks charge each other in order to hit their reserve requirements. So depository institutions are required to have a certain amount of deposits on hand. And if they're falling short, they'll borrow money essentially from other banks in exchange for what's called the Fed funds rate. Now, because the Fed funds is an ultra short-term loan, it only directly impacts other short-term loan products like money market accounts, credit cards, or auto loans. The Fed funds affects the bonds market, but it does not directly impact mortgage rates. And that's how we ended higher, even though the Fed cut interest rates by a point. So then what does directly impact mortgage rates? Why do mortgage rates track the bond market? To put it simply, it's because both bonds and mortgages are considered long-term investments, and they also have similar risk thresholds. So the 10-year treasury and the 30-year fixed rate mortgage are considered similar both on time horizon and risk threshold. That's why the mortgage rates track the 10-year treasury. And you can see right here on the right-hand side, the orange line format how closely the mortgage rates track that 10-year treasury. Now, when you're going through the process of a transaction as a buyer agent, your experience with the lending world, the loan officer, him or herself. I want to show you exactly how it works in the lending world so you can start to understand the different players that are in play for affecting interest rates. So in order for a lender to lend out money, the majority of them have to get their capital from somewhere. And so we'll call that investor number one. The investor is going to provide money to the mortgage company in order to originate loans in exchange for an interest rate. We'll call that cost of capital. Now, when the investor is determining what interest rate they will charge the mortgage company, it's obviously going to be based upon what inflation is doing, as well as what they expect inflation to do over the preceding term or the following term. You see, the last thing an investor wants to do is lock up, $100 million at an interest rate, and then inflation spikes and they're essentially losing money to lend their money. So the investor is going to provide their capital in exchange for an interest rate which they feel is safe for both current inflation as well as expected inflation. The mortgage company will then originate the loan. Now, both players in here have to get a rate of return. That's called yield. The investor gets it from the interest rate. The lender will get it from origination fees. Now, when I told you that the foundation of the 30-year fixed rate mortgage is that 10-year treasury, but that's not the only component in it. There's three main buckets. Now, when the investor lends to the mortgage company, we call that cost of capital. Then the mortgage company will have their operating costs, called their own yield as well. Those three factors are what goes into what we call the primary spread. So that's the initial margin that gets added to the 10-year treasury, which allows for the mortgage company to cover their costs and make their rate of return. Now, when inflation goes up, that increases the cost of capital, but also increases the cost of doing business for the lender. So that will drive the primary spread higher. When the Fed funds increases their rates, that increases the cost of capital as well, but it also increases the yield that the mortgage company needs to make. And that at first glance may seem perplexing. Why would raising the Fed funds rate force mortgage companies to charge more? And that's because there's a third player in the mix. Of loans will get sold on the secondary market. And that's where they get packaged into mortgage-backed securities. The majority of them get bought by Fannie and Freddie. However, there's about a quarter of loans that get purchased by private companies that get bundled into what are called non-agency mortgage-backed securities. So these are the three, to put it simply, these are the three players that are involved in the mortgage process. Each of them has to get their target rate of return. Now, I want to give you a direct answer as to why when the Fed funds rate goes up, they need to make more money. And that is because in order for a mortgage to be an investable asset, it has to provide yield that will justify the risk that it entails. But mortgages aren't the only product available. So here you can see, for example, a money market fund that is yielding 4.75% as of the end of January. And Street is looking to purchase mortgages, the yield from the mortgage has to be higher than what they could get from just a money market fund. For example, money market funds have zero risk. They're backed by, they're FDI insured. So that is the factors in play here. You have the 10-year treasury, you have that primary spread, which is effectively the cost of doing business plus the return for the mortgage company. And then you have the secondary spread, which is what the market will demand in order for those loans to be sold on the secondary market. Now, let's dig a little bit into the bond market. Now, we started off today's webinar talking about how the Fed lowered the Fed funds rate by a full point. I want to show you how that plays out essentially in the market to exactly the scenario I was just explaining. So in September 2024, the Fed funds rate was at 5.5%. Money market funds, which track that Fed funds rate, were also at 5.5%. But the 10-year treasury was at 3.9. No investor in their right mind would put their money into 10-year treasuries for a yield of about 1.5 points less. And so that is the dynamic that has to be in play. If we want interest rates to come down, we'll need investors to start putting money in their 10-year treasury. Now in January, the Fed funds rate was at 4.5. Money market funds were at 4.5 and the 10-year treasury is at 4.6. So now you can start to see the factors coming into play, which will eventually lead to lower interest rates like we're seeing right now. Now, no investor, again, is going to put their money into the 10-year treasury for just an additional 10 basis points of spread. So we need that delta to expand a bit more, but we're getting closer. So when the when the Fed cut the Fed funds rate, if you guys remember, this happened, they exceeded estimates and they cut the Fed funds rate by a half a point, and interest rates spiked. So what explains that? So this is from Bloomberg Finance, JP Morgan. And basically, they did a study by tracking different asset classes and used that as a proxy to understand what was driving investors' behavior. And basically, after the Fed cut interest rates by a half point, interest rates spiked because they were concerned about growth exceeding expectations, which therefore would put pressure on yields. They were also concerned about economic uncertainty surrounding inflation and the fact that the Federal Reserve itself, the board members of the FOMC, were very split on how many rate cuts would happen in 2025. In total, there was 150 basis points of variance. So to put it simply, the uncertainty surrounding that decision and what it would mean for the market caused everyone to get super skittish, which is why interest rates spiked a full point in the following weeks. Now, this is arguably going to be the most important part for us understanding what's going to happen with interest rates this year. It comes down to inflation. Now, how does the government measure inflation? This will probably be a bit surprising to you. If you're familiar at all with economic data, you've probably heard about CPI, you've probably heard about different factors when they report each month. But the gold standard of inflation data for the Federal Reserve is what's called PCE, personal consumption expenditures. More specifically for our industry, it's core PCE. Core PCE removes data that revolves around energy and food prices because those are not particularly susceptible to Fed Reserve policy, and they're also susceptible to external influences like weather or OPEC, for example. Now, in November, the core PCE was at 2.8% with a target of 2%. Now, in core PCE, there's an 18% weighting. 18% of that index is what's called shelter or housing. In CPI, which is a more general inflation metric, it's actually 48%. But what's really important about this is understanding how the Bureau of Labor Statistics actually defines the cost of shelter. Whenever I run this training, I ask the audience, and typically they throw out, oh, they're going to look at median sale prices or something to that regard. They're going to look at market demand and supply. But in reality, the government data does not look at home values to determine the cost of housing. They only look at what they would consider shelter as a service, or put simply, rents. But to make it a little bit more confusing, it's not just rental data. They actually use what's called imputed data. And they do that through the American Community Survey. And this is where it gets super wonky. What they do is they call up homeowners in different regions each month. And they're going to call them and say, how much do you think you could rent your home for if you rented it? It's totally theoretical. It's not practical. It's not that they're actually leasing their house for this amount that month. They're living in it. It's their primary residence, but they're going to ask them what they think they could lease it for. And that's what's called imputed data. And that imputed data and the process by which they acquire it, which causes them to be lagging on average by about 4 months behind private sector data, is how we get to a fact like this. So core PCE shelter had it at 4.8% inflation. CoreLogic, which runs probably the preeminent rental index, had it at 1.7%. That's a 3.1% overstatement for the cost of housing and the inflation rate. So when you take 3.1% times the 18% weighting, that's a half point. So remember, they said the PCE was at 2.8%. When you subtract a half point, now in reality, if we're assuming that CoreLogic's data is correct, then that in reality we're at 2.3% today. To take another look at it, you can see the breakdown of new leases and renewal data. This was from November. And I'll show you what's going on currently on the next slide. So back in November, Realtor.com had new leases at negative 1.1%. Apartment List had them at negative 0.6%. Zillow had renewals where the landlord has a bit more leverage at 3.4%. So on a weighted average in November from these private sector data sources, you had the rate of inflation of housing at 1.25 to 1.5%. Another overstatement. In January, it's at negative 0.2% on Realtor, negative 0.4% on Apartment List, and on renewal data, it's at 2.3%. So when you look at a blended average here, now you see that as of January, it's somewhere between 0.4 and 0.5%. Yet the government data in January has rental data at 4.5%, and the CPI data, which is as of February, at 4.2%. So if you look at month over month, you can see that the government data is catching up to where the private sector data is showing already. And we had a great inflation report that came out just a little over a week ago, which had core PCE here at 2.6%. You may have seen that in the news reported. That was a very encouraging sign that inflation is coming down, or more so that the government data, which everyone looks to, is actually coming more into a line with what the reality seems to be. Now over here, this is a CoreLogic index, and I just wanted to show you two things. So on the first two columns, you have core PCE and CPI. Those are inflation data. That's the cost of rents. The CoreLogic side is home values. So we're in a nice situation right here for a buyer agent where you have home values continuing to appreciate while the cost of renting is coming down. So it's a better situation for consumers overall. Home values are still staying strong if people are looking to achieve home ownership. Now, I mentioned earlier that the data is always lagging on the government data, and that's because, like I said before, they separate the country up into regions. They don't have the manpower to survey every region every month, so they do one region per month, which means any given month, all the other regions are held consistent. And so when you think about it, how it rotates through, each month one region gets updated, the other ones are held consistent. So not only does it take a while for the government to report the data, it's typically 30 to 60 days behind, but in any given report, 3/4 of the country is even further behind. So those are kind of the dynamics we're dealing with as we're looking for the government data to catch up. Now, if we want inflation to come down, one of the best bets we have, and this isn't political, it's just a reality, we need the government spending to decrease, because right now, if you're running a $2 trillion deficit, every dollar that's spent above what the government takes in revenue is by definition inflationary. So if they reduce the amount of deficit, that will have a downward pressure on inflation, which will make the Federal Reserve more bullish in terms of cutting interest rates, lowering the cost of money, lowering mortgage interest rates for everyone overall. We basically surmise that the core PCE data for this year will end in the ballpark of 2.1 to 2.3%, getting very close to the Federal Reserve's target of 2%. So that's, again, good news. If you've been tracking the 10-year Treasury since January, it's already fallen a half point. So rates are really coming into a nice little sweet spot for us, and we predict that trend will continue. Now, another key factor is on the employment side. There are two key metrics that tend to get tracked on the employment side. That's U3 unemployment and U6 unemployment. U6 unemployment takes into account the total labor force of able-bodied people in the United States. U3 unemployment excludes the people that are able in terms of their body capabilities to work, but they are considered disaffected, meaning that they stopped looking for employment. Now, on the employment side, there's also a little bit of wonkiness that will help you understand what's going on in the back and the forth. So each month, the Bureau of Labor Statistics will put out an employment report, and this is their forecast. Their forecast of how many jobs that they think were created. Then 6 months later, there'll be a thing called the QCEW, the Quarterly Census of Employment and Wages. This is where the government reaches out to the biggest companies that employ 95% of Americans and will actually get their employment data to get a very clear, very solid understanding of what the employment numbers actually were. Now, when one of the concerns over the past few years was that the economic data was basically signaling that we were at peak employment. And inflation was high, but it came down. We know that's still lagging from what we just talked about. But the employment data was still showing that we were at peak employment. And so this gave investors, people, calls for concern that the economy could overheat, causing to a rise in inflation. But the QCEW last year led to published a revision. It was actually the largest revision that they've ever had. So the Bureau of Labor Statistics overestimated employment by 818,000 jobs. Then in December, they basically signaled on the right-hand side, you can see here a report where they signaled that there would be an additional revision. And that revision came out last month. In all, total employment was revised downward by an average of 626,000 jobs each and every month of last year. In total, employment increased just 308,000 in calendar year 2024, and our labor force participation still remains below 2019 levels. So we have inflation coming down and we have signs of economic softening. These two factors will lead, arguably, to a more dovish policy, a more bearish policy at the Federal Reserve. So to tie it all together with a little market forecast here, since mid-January, the 10-year Treasury has fallen from 4.8 to 4.3%, a full half point. If you remember, that's the foundation of a 30-year fixed rate mortgage. So arguably rates have fallen about a half point in the past, call it 6-7 weeks. We predict that the 10-year Treasury will end the year in the ballpark of 3.6 to 3.8%. And we feel this not just because of the economic data, but also because of the previous technical lows. So you can see here on the right-hand side, this isn't out of the realm of expectation. In fact, we touched on this level in September of last year. So rates were falling, the 10-year Treasury was falling. In September, it hit about 3.5 and a half. But then that's when the Fed cut interest rates by a half point, and you can see how it spooked the market. So we feel that it will likely test those previous low levels, and we're predicting that it'll end up in the end the year in the ballpark of 3.6 to 3.8%. Now, here is the current makeup of the Federal Reserve Board that decides what they do with that Fed funds rate. So the consensus is that you have 10 members that are in favor of 2 additional cuts this year. And then you have the rest of the members here. You have 3 members that are in favor of 3 cuts, 1 for 4 and 1 for 5. Now, this makeup was based on the data that previous to the one that was just released. So now we're seeing inflation come down. We're starting to see employment numbers soften. And so what we believe is that more members that are currently in favor of the 2 cuts will begin to shift downward or upward to 3 or 4 cuts in calendar 2025. Now, on top of it, to circle back, we talked about the primary spread and the secondary spread. Now, these spreads have been well above historic norms. So the primary spread from 1995 to 2005 averaged a half point. Now, since the Great Recession, we've averaged over a full point. This shift was largely due to the increase in the cost of originating a mortgage, as well as an increase in the guarantee fee charged by Fannie and Freddie. Fannie and Freddie are now supposedly to come out of conservatorship, meaning that they'll go back to the private sector and no longer run by the federal government. So there is a case to believe that the primary spread could also shrink. The secondary spread averaged 0.71% since the Great Recession, but from 2022 to 24, it's been at 1.4%, double the average since the Great Recession. And this was due because the Federal Reserve began to work down their balance sheet. Since the Great Recession, they engaged in a policy called quantitative easing, which means the Federal Reserve was buying mortgages off the market. Now, the Federal Reserve is considered a non-economic buyer, meaning when they're buying a mortgage, they don't care what it yields. They're not in the business to make money. And so that had downward pressure on the secondary spread. But since 2022, the Federal Reserve has begun to whittle down what they're doing and to sell off the mortgages that they had on their balance sheet. So there is also a case to be made that the federal government could resume quantitative easing policies to drive down that secondary spread to provide more relief to home buyers. We believe that the primary and secondary spread combined will fall about a quarter of a point. Right now, it's at 2.5%. The previous levels before average between 1.6 and 2% total. We don't think it's going to get that low unless there's significant quantitative easing, but we believe it can fall another quarter point here, which will again provide more relief to home buyers. So to summarize, when you put these pieces together right now, we believe rates can fall to the realm of the high fives, low sixes by the end of the year, which is a really important level because when we previously tested that in September of last year, mortgage applications skyrocketed. In those few days, mortgage applications increased 14.2%. And refinance activity jumped 127% year over year. So that is kind of how the mortgage industry works, both in terms of the players as well as the influences that are involved in either increasing or decreasing mortgage rates. It's also our forecast for what you could expect to see play out before the end of the year. I know I threw a lot at you, so we'll answer any questions now.
I have a question about rates, during COVID. I mean, obviously those were somewhat artificial, right?
Yeah.
What were they driven by? Anything at all? Because I mean, there wasn't inflation, like were they just how were they thought up or figured out?
So the Federal Reserve lowered the cost of money to zero. On top of that, the federal government was spending a ton of money, but because lockdowns, GDP
Yeah.
plummeted. And so they basically counterbalanced out. And so you had this paradigm where money was super easy to get because it was being pumped into the economy, and you had the cost of money being at zero. And so that's how I mean, I was just looking back through transactions that we did in 2021 and 2022. Interest rates were below 3%. It's
Yeah, they
wild.
were crazy.
Probably never see that again.
Yes, that's what I was gonna say. You're never gonna see that unless something drastic happens, right?
Yeah. I mean, if we see that again, we're probably in dire straits.
Yeah, we don't. Well, that's the funny thing. Like, we don't necessarily want to see that again because that means that something terrible is going on, right?
If we see that again, home prices will just continue to skyrocket. And so you'll have this situation where home ownership becomes even more out of reach.
Right,
The
because there's
biggest
more competition.
Yeah, I mean, interest rates aren't out of historic norms just looking across all time. I mean, right now we're depending on the product, you're going to be like in the with no cost mid sixes. With a little cost, you'll be in the high fives, low sixes. Um, but if interest rates go down, money gets cheaper, home values will appreciate. And so right now, the biggest challenge for homeowners really isn't the cost of money like it has been in previous years. It's lack of supply and the fact
Hmm.
that home prices are so high while interest rates are high. And if there's only so much housing around, then it just keeps
Yeah.
home prices. When the Federal Reserve increased interest rates at the fastest clip possible, home values stayed consistent. in a typical market, when the cost of money would go up, home prices would fall. That didn't happen over the last 5 years.
So when you say, oh, when people say, oh, I wish that housing was cheaper, it's not gonna, nothing's gonna really, nothing really would bring, unless there's, a recession again, will bring down the cost of housing, but it can kind of like keep it more steady, correct?
Yeah, I mean, unfortunate because the only real solution is providing more supply. All the other solutions
Right.
increase demand. And if you're not doing anything on the supply side, you just have more money chasing after the same houses in circulation. And so therefore home values get more expensive. So all these other solutions, which are great and they certainly help people, when you consider the overall economy, it makes housing more expensive.
The only people that want housing to be less expensive are people that don't own houses.
Yeah.
You know what I mean?
Yeah.
Like, I love to see how much my house is worth. You know what I mean?
Yeah,
It's just such a funny situation.
as soon as you make the switch from being a renter to a homeowner, then you just want
Yeah.
it to go through the roof.
Right,
So
exactly. Like, I don't want my house to go down in value. If I see it go down like a couple thousand on Zillow, I'm like, ugh, don't worry. I don't rely on Zillow, guys. I'm just saying
yeah,
that when I
awesome.
see that, that's what the consumer is looking at, right? Brandy
Yeah,
says they have plenty of supply. Where are you located, Brandy? I mean, you're in Florida, Rob, so they're always building in Florida, right? Seems
yeah. I
like.
mean, the
Yeah,
Florida
she's in
market is
Sarasota.
pretty. Yeah, Florida market is pretty soft right now. There's been so much demand over the last few years that it's kind of. It seems like it's petered out a bit, but now we're heading into spring market, so I think it'll peak back up in about 30 to 60 days.
I think that this was super informative. I mean, I'm not a numbers person. I never really have been, but like it makes it a little bit simpler to understand like everything kind of works together. I think a lot of people just think, oh, they just create these rates, but I mean, everything kind of go. I mean, you didn't have inflation during COVID for that, so that was one, you know, probably one reason why they're able to stay so low.
Hmm.
So, did inflation kind of happen because we came out of COVID and things were catching up, or what's your take on that?
Inflation largely spiked because the level of government spending continued after the
Okay,
economy reopened.
got it.
So, during COVID, regardless of what you think, the loss of GDP was counterbalancing the increased government spending. So it was just a net even. And that's why inflation was still at a constant around a little over 2%. But when the spending continued at really unprecedented levels, it's how
Yeah,
inflation skyrocketed. In fact, Lawrence Summers, was he not only he was Secretary of Treasury for Clinton, he was also Obama's economic advisor. He came out after the reopening came out and was basically saying that spending needs to stop. He said, quote, this is going to be the most irresponsible macroeconomic policy we've ever seen. We're going to head into hyperinflation. And,
he
unfortunately
was
he
kind
was
of
right.
right.
Yeah.
Yeah.
Uh, so yeah, so
Glenn in the chat says this is high level information. Will there be a recording? Yeah, so you'll be able to go to the LabCoat Agents YouTube channel. If you go subscribe, go to YouTube, just search LabCoat Agents, it'll pop right up. Just subscribe and click to be notified of all of the. Oh, there you go. Young just posted in the chat. Easy. Just click that. Be a subscriber, turn on notifications, and it should be up there within the next 24 hours. Yeah, definitely a lot of great information. Appreciate it, Rob. If they want to reach out to you in any way, shape, or form, they can reach out to you at Rob or Robert at Moxie Mortgage.
Robert, I'll put in the chat
Oh
box.
yeah, drop it in the chat because I'm sure people have. I think it's super important for agents to track this stuff. You know what I'm
Yeah,
saying?
and I threw a ton at you, but like really, if you just track a couple things, just track the U3, U6 unemployment, and more especially just what that core PCE number does. It gets
Hmm.
published once a month, and whenever it gets published, it gets huge news because it's what everyone's watching. And so, to put it really simply, if we want rates to come down, the Federal Reserve is looking for signs that the economy is softening because then they're going to want to lower rates to provide a little bit more demand into the
Yeah.
economy. So if inflation keeps coming down and you start to see unemployment go up, then you'll start to see Fed members start to cut interest rates more, which the bond market will respond and mortgage rates will keep falling.
I remember like my parents, I mean, I don't remember because I was like 6, but like my parents tell me, in the 80s, they would have 15, 9, 17% interest rates. Quickly, like how does that happen? You know what I mean?
That was hyperinflation era, so the Federal Reserve had to raise interest rates so high to try to quell the rate in which inflation was spiking. And
Crazy,
so,
man.
yeah. So the Fed, you have so many different players. You have obviously the private sector trying to run businesses, and there's three different players involved: the investors, the lenders, and then Wall Street. The Federal Reserve is just trying to basically maintain a stable level of rate of growth around 2%. And so that's what they're just trying to do, is to maintain the balance. So if you
Yeah.
can separate how the private sector works and how the government works, you'll start to understand how things play out.
For sure. All right, man. Appreciate it. Great presentation as usual. Like I said, go to YouTube at LabCoat Agents. Reach out to Robert at moxiemortgage.com if you have any questions. And we'll see you on the next one. Everyone have a great Monday.